Big changes are arriving for NPS from 1st of October under the new multiple scheme framework. Non-government subscribers can now hold multiple schemes under one PRAN and invest up to 100% in equities in a high-risk variant. At the same time, PFRDA is revising annual maintenance charges as well via a slab structure, setting upper caps based on corpus size. Now, also draft proposals suggest more flexible exit and withdrawal rules, shorter vesting periods, and higher lump sum limits. This is exactly what we're going to talk about today, what this means for your retirement planning. And to discuss all of this, we're joined by Rohit Chow, the co-founder and CEO of GYR Financial Planners Private Limited, joining us now. Rohit, hi. Thank you so much for taking out the time and speaking with us. Take us through the entire view of what's happening from 1st of October. What are the changes that one can expect or anticipate from 1st of October in NPS?
Yeah, sure. Thanks, Mahima, for inviting me. And I think this is a very interesting topic that we are picking up today, extremely concurrent with the changes being recommended. And I think we have seen NPS for the last 15, 20 years, and it has been like the stable, steady, simple product, very limited choice, very basic variants. Now, what is happening is that some amazing changes are being brought in, and we can say this is like a NPS 2.0, where they're trying to make this very competitive product. And what they're trying to do is allow us a selection of multiple schemes where we can invest our money. So I think that is very interesting that today, if I am picking up one scheme for equity, that stays my core scheme and I'm not able to change to any other scheme. What the proposed model will allow is that based on the performance and the need, I can go across multiple schemes from the different fund managers, and I can do that under the same plan. That's a great sort of change which is coming up. The other thing which has been a long-standing demand is flexibility, when there is an active, choice option is being defined. Now, now a subscriber can go up to 100% of the equity if required in his or NPS fund. So this is another great benefit that is being rolled out. Let us debate whether this is going to be greatly useful in all situations, but that's the benefit that is coming in. They're also changing the cost structure. There are further proposals to increase the lump sum portion of the maturity to be taken, probably almost to the 80%, but I think that proposal is still under consideration. They're also talking about increasing the cost of maintaining the PMS, so that's probably not a very great development that I can see. And then there's also the core scheme and the multi-scheme framework. So one in the multi-scheme framework, after 15 years, there's a greater flexibility to change. So these are some of the key changes which are coming up in the NPS, and the private sector subscribers should watch out. In fact, the concept of persona is something very, very interesting. I don't see in any of the government regulated product this concept coming up. And if you are a gig worker, if you are a self-employed, if you are a woman, conservative woman profile, I think the plan is to offer different options, and based on that, the portfolios can be different. So I think a great amount of customization is coming up, and that's a great news for all the PMS, all the NPS subscribers.
Okay. Rohit, does this mean that the shareholders will have any impact? Introduction of the multiple scheme framework that we're talking about, will that have any impact on the shareholders?
I think if we are talking about the NPS subscribers, I think they will have largely positive impact, because these changes mean that a lot more flexibility the way they manage. And for example, if this lump sum withdrawal at maturity is allowed from 60 to 80%, then I think that's going to be even more helpful. And I think I also read the proposal that to maintain the corpus till the age of 80, 5 years, if I'm not wrong. So I think these changes are going to be greatly helpful to subscribers. The only one change that I found was probably not going to be greatly helpful to subscriber is that, roughly around 0.10% was the cost of NPS fund management so far. Now that is being increased to around 0.30, and then under some circumstances, the fund managers can even charge slightly more. So that is one, development, Mahima, I will say is not a very great development from a subscriber point of view, because today, if you look at the cost of fund management in India, and if you look at a diversified mutual fund option, index-based portfolios, one can pretty much do with a, let's say a 0.35 or a 0.40% cost. And that includes a lot more variety than what an NPS does. And NPS coming very close to 0.30 is becoming, lesser competitive from that point of view. So one of the great benefit of NPS, which is being extremely low cost, is being taken away with these changes.
Interesting. What does this new 100% equity investment option mean for non-government NPS investors? I'm just trying to understand as to how this will change the scenario.
Right, right, right. I'm not seeing this as a more, you know, uh, output generated option, which means I'm not saying that a subscriber with a 75% equity will now be able to generate more return because the equity element can go to 100%. And for that, we have to take a little bit of, backdrop here. If we were to think of a multi-asset class framework approach, Mahima, what we are talking about that an investor based on his goal, risk appetite, should look at different asset class, which means equity having a single, asset class full 100% exposure is normally not a good idea. But the way this 100% exposure, is a good idea in the NPS structure is that normally a pension fund subscriber has so many other assets, and he also or she also is investing into NPS. Now what happens is that when you have a flexibility to keep this to 100%, it becomes slightly easier for you to manage your overall portfolio, rebalancing, asset allocation, and you may not even disturb the NPS for a very long period of time. So from that point of view, that's a great facility, and that's a great feature. It is like uh, take it up to 100%. Just consider the market value of the amount in your annual rebalancing and asset allocation decision, but you may not need to rebalance the NPS part because it's all set with the 100% equity.
Okay, but Rohit, don't you think this increased exposure in equities will increase the risk for the NPS holder? Because the idea of investing in NPS was that it's a slightly safer investment that you make, right? I don't know how is the understanding on that aspect.
That is true. That is true. There are so many dimensions of risk here, Mahima, we have to think about, because if you were to look at, a subscriber doing NPS for a 20 or 30 years, she has a fairly long period of time to invest. And from that point of view, if you were to look at historical, you know, framework of the data, the risk is not really in an equity volatility, but the risk is really in the purchasing power, which is inflation. And from that point of view, it is not really a risk. Uh, and if you look at the construct of the NPS, they've been sticking to, I think, Nifty 50, and they've been slowly going up to Nifty 100. And hopefully there will be more options, in the future. So the nature of the equity itself per se is not very risky, but it all depends upon the margin of safety, when one has entered, how much time one has. If let's say a pension subscriber is investing into NPS in the last 5 years of a working life, then we have a possibly a challenge, because
Right.
the time is just not enough to compound.
And what are the kind of changes that have been proposed for withdrawal or NPS exit?
So what I think we have to wait for more details. What exactly is becoming implementable from tomorrow, and what exactly is still proposed. So, for example, I think in the multi-scheme framework, after 15 years, the changes are allowed in the scheme. So that's considered as a holding period or a lock-in period. So I think this is one change that I can see. The second change that I can see is that currently the rules are the vesting happens at a 60 years of age when one is retiring. Now, currently there is an option that you can maintain the status quo and take the corpus till the age of 70. And now the proposal that what I can see in one of the latest media update is that it can go up to like 80 85 years. So I think it is allowing a greater exit and greater flexibility for one to manage. And the other exit option that I can see is from a settlement point of view. The proposal at this stage is that can the 60% lump sum be go up to 80% lump sum, which means only 20% is the annuity that one would need to take. I think this is a great development. If this proposal really works out, it will bring NPS come very close to employee provident fund, because as you know, in the EPF the money is available when one retires at 58 or
Yeah.
60, and there is no annuity, there is no tax, you get the whole money, in your hand.
Understood. Rohit, thank you so much for giving us all these insights. I'm sure that our viewers will make a sensible decision now after hearing this conversation with regards to their NPS investment. So thank you so much for giving us those insights and of course taking out the time and speaking with us at NDTV Profit.
Sure, my pleasure. Thank you, Mahima.
Thank you so much. With that, viewers, it's a wrap on this edition of Your Money Matters, but do stay tuned. More news and updates on the other side.